Well, thank you all for attending. It's a big audience, and thank you for inviting this paper. So the title is Inflation and Disintermediation. I'm Verner from Cornell, and this is work with Isha Agarwal at UBC. So, I think it sort of needs no motivation. Inflation sort of has been a recurrent problem, both in emerging markets and in advanced economies, including today in the US. So in this paper, we're going to ask sort of a classic question. We're sort of revisiting this old question, which is, what are the channels through which an unexpected increase in inflation affects the macroeconomy? And we're not the first, of course, to sort of ask this question. And macroeconomic theory has provided a variety of sort of theories about how, in a causal sense, a rise in inflation can either sort of increase or depress GDP. Now, in this paper, we're going to, without sort of commenting on these sort of previous theories like Keynesian theories, we're going to test and propose and test sort of a new channel that we're going to show is quantitatively important and not been studied yet. We're going to propose and test a banking channel through which unexpected increases in inflation affect the macroeconomy. And sort of the broad idea behind this is that banks can be inflation exposed because of asset liability mismatch, because of the composition of their balance sheet. And when there's an unexpected rise in inflation expectations, this could hurt bank value and in turn depress lending, which could have real consequences. And that's what we're going to show in this paper. Now, I'm going to start out by showing you some sort of broad trends across historical inflation episodes around the world to show that this is broadly relevant. But this is going to be mainly a natural experiment paper because we want to show a causal connection. When there's a rise in inflation, does this actually impact bank lending? And so I'll go through the details of this natural experiment, which is going to look at US banks in 1977. I'll sort of explain the context, our identification strategy throughout this presentation. But the main result is going to be that the banks that are the most inflation exposed are going to reduce lending. There's going to be sort of a big aggregate effect on lending, and this is going to affect, in particular, sort of residential mortgages. And in terms of the real effect, we're going to see especially, this is going to depress house prices and construction employment in affected geographical areas. Okay, so first, a quick word on the methodology in this paper. So one thing we do in this paper is for every bank, we're going to build an inflation exposure measure. And it's going to conceptually capture the sensitivity of real value of bank equity to unexpected shocks in inflation expectations. Right now, the way we're going to do this is for sort of banks as a whole, we're going to look at the balance sheet items on each bank and classify balance sheet items both on the asset and liability side as to whether sort of they're positively or negatively exposed to inflation. So we're going to assign each balance sheet item a +1 that's inflation exposed, meaning sort of theoretically we would expect bank value to decrease with higher expected inflation. And some balance sheet items might even help hedge the bank. So when there's higher inflation expectations, that might actually help bank value. So just to give you a few examples, on the asset side, if a bank holds a lot of long-term nominal bonds, then that bank is going to be hurt by higher inflation. But if on the other hand, on the liability side, they have a lot of non-interest bearing demand deposits, that, paying 0% interest, they effectively pass on inflation to their depositors, so banks may be hedged, right? It's sort of the way that assets and liabilities hedge one another. And so calculating sort of the net inflation measure, which is going to net out both the asset side and the liability side of banks, we sort of get a total bank inflation measure that's going to range between -1 and +1. And +1 always means that when there's sort of an increase in inflation, that's going to hurt bank value. And if it's negative, actually, that means that bank value theoretically would actually go up. So we could do that bank by bank in our sample. And so let me start with some motivating facts sort of around the world and sort of, in historical inflation episodes. So the first thing we do is sort of at a macro level, we look at, a sample of almost 50 advanced and emerging economies since 1870. We look at increases in inflation that are large, greater than 10 percentage point increases. And what we show is that they tend to be followed by aggregate contractions in bank credit to GDP, as you could see based on this impulse response. Now, of course, one of the issues is that this may not be causal, right? And that's what we're going to show in the natural experiment. But it does show that if you look at the bank credit to GDP ratio, high inflation tends to be followed by aggregate contractions, right? And it's bank credit divided by GDP. So it's not just that aggregate output is falling. Bank intermediation is falling faster than GDP. Now, the second thing we show is just sort of a broad pattern around the world across inflation episodes is that it's not, in terms of this aggregate contraction, it's driven especially by the banks most exposed to higher inflation, as sort of quantified by our inflation exposure measure. So this is sort of a cross-sectional test of banks. Let me sort of just show you a few graphs to orient yourself. But for each individual sort of inflation episode, so here's sort of a few examples, like Brazil in 1992, Indonesia in 2005. On the x-axis, we're going to graph the inflation exposure measure. And then on the y-axis, we're going to look at subsequent lending after inflation goes up. And you can see there's this is bank by bank. These are bank level regressions. Each dot is a bank. And you can see there's a clear negative correlation. If banks have higher inflation exposure measure, the year before inflation goes up, those are the banks that reduce their lending the most after the inflation increase. And so if you sort of pool all the episodes together and run this with sort of episode fixed effects, this negative coefficient basically corresponds to that negative slope. The lending contraction is driven specifically by the most inflation exposed banks. Okay, now again, there's sort of an identification issue that this sort of motivates, which is that the banks that are most inflation exposed might also be different along other dimensions. And so all those sort of identification concerns sort of lead us to this natural experiment where we're going to test the causal effect of inflation on bank lending. Okay, so let's turn to the US in 1970s. And so one thing I want to walk you through is sort of all the different sort of inflation episodes in the US, because this is actually a relatively small inflation, right? It's not one of the big ones people think of. It's good for identification purposes, but I want you to understand where this fits in terms of, US history. So there are 4 distinct increases in inflation in the 60s and 70s in the US. The first occurred around 1968, driven by, high government spending and the Vietnam War. Then inflation subsided, but it rose again in 1973. This is sort of popularly associated with the oil shocks. Then inflation subsided again. And in fact, in 1975 and 1976, as inflation moderated, the Fed abandoned its anti-inflationary stance and focused mainly on lowering unemployment. So this is going to be helpful for us because the Fed was not tightening. The Fed was not raising real rates. In fact, in retrospect, the criticism is that the Fed was asleep at the wheel. And we know from sort of Romer and Romer that the Fed was not tightening in 1977, not until 1978. That's going to be good for identification because inflation, again, sort of rises in 1977. It goes from 5% to 7%, where it plateaus for about a year and a half. And then the last and fourth inflation episode is going to be the big one in 1978, where it reaches over 13%. But we're going to focus on this third one, sort of more moderate, but as you'll see, good for a natural experiment. Now, why this episode? Well, it's sort of a clean episode in our view. It's a one-time increase in inflation from a 5% rate to a 7% rate in core inflation, where inflation sort of plateaued until mid-1978, when it accelerated again. And it's mostly attributed to sort of a single cause, which is a shock to energy prices, which then filtered into sort of the broad price index, as you can see here, due to a very cold winter in January 1977. Okay, so we're going to use that sort of inflation increase. And then other things that are important. So there's very few confounding factors. There was no monetary tightening, even though maybe there should have been. We know from Romer and Romer and from reading the FOMC minutes that there was no sort of tightening in policy. Real rates didn't rise in that year. There are no big changes in exchange rates, long-term interest rates, or bank regulation. And then the other thing that's sort of important is we're going to use state-level reserve requirements for identification. And before 1980, Fed non-member banks actually had individual state reserve requirements, which we're going to use in a second. But this was abolished in 1980. So we're going to study this even before 1980, before it's abolished. Okay, so our data is going to be sort of standard call reports bank data. Our inflation exposure measure is always going to be measured in December 76, so the year before the inflation increase. And then we're going to look at different outcome variables like bank lending and real outcomes. So the inflation is going to hit in like first quarter 1977, and we're going to look at outcome variables until the end of 1977. Okay, so here's our identification strategy. We're going to look mainly at Fed non-member banks. And the reason is they had different state level reserve requirements set by individual states. And that's going to affect their inflation exposure. Right, so the way to think about this is that some states, like Illinois back then, had 0% reserve requirements for their non-member banks. But other states like Maine or Florida had reserve requirements that were very high, like 20, 25, or 30%. And we look at reserve requirements that affect your holdings of non-interest-bearing cash. That's going to be bad for inflation. If you're forced to hold on your balance sheet 30% of your assets as non-interest-bearing cash to get 0% interest, you're going to be hurt when inflation rises. So this is going to give rise to exogenous variation in the cross-section of banks across states in their inflation exposure measures, as we'll see. So among the Fed non-member banks, there's going to be this sort of continuum across states in reserve requirements. And then we're going to have this control group, which is the Fed member banks. These are members of the Federal Reserve System. Their reserve requirements were uniformly set in Washington, D.C., and so there's no variation across states. So identification is both going to look sort of across states at the non-member banks, but then difference out sort of within state, non-member versus member banks to control for state level characteristics. Now, econometrically, the way we implement this is following the IB framework set out by Duflo. It's a little more complicated than a standard IB because you both have this differential treatment effect across states among the non-member groups, but then you also have to difference out the member banks, and Duflo sort of tells us to set up the equations like this. You'll see sort of how it works on the next slide. So the first stage is going to show that if you're in a state and a non-member bank with higher reserve requirements, you're going to have a lot higher inflation exposure measure for those banks. Right, so the way Duflo tells us to look at this is to interact an indicator variable of a non-member bank with so NM is non-member and RR is reserve requirements. So non-member banks and higher reserve requirements in that state. And as you can see, the banks with higher reserve requirements, those non-member banks have a higher inflation exposure measure in 1976. So that's the first stage, right? Higher reserve requirements induce those banks to have a higher inflation exposure. Then in the second stage, we look at the fitted value of inflation exposure and show that that's going to lead to a reduction in bank lending. So this is lending over the subsequent year. And the more inflation exposed banks have a negative coefficient. So for example, if you have a 10% inflation exposure, that's going to lead your total loans to be reduced by about 2 percentage points.
Sorry about that.
Okay, sorry, my clicker actually doesn't work now. Thank you. Good. So in the last sort of 5 minutes, I just want to talk about channels. So, there are various sort of banking channels that we could think about. And we delineate those in the paper. So the first is sort of a more standard bank net wealth channel. The idea that higher inflation, because of the balance sheet asset liability mismatch, is going to depress banks' net wealth or cash flows, and that's going to lead to lower lending. We also think about a loan misallocation channel. And this is the idea that it's about inflation uncertainty or inflation volatility. There's a lot of expected higher inflation volatility. Banks are going to shy away, especially from very long-term loans. And this especially means like 30-year sort of fixed rate mortgages in the US. Right? And they're going to shift more towards sort of short-term loans, index loans, and also sort of interest-bearing securities. So this is going to be more of a substitution channel away from like long-term loans to more inflation-protected assets. And then the third channel is the deposit outflows channel. We don't study it that much in this paper. This is sort of this is studied very prominently in the paper, a recent paper by Dreschler, Savoff, and Schnabel. This is the idea that in the 70s and 80s, there were regulatory ceilings on deposit rates. So if your time deposit rates are capped at 3%, but inflation or interest rates rise above 3%, people are going to not put their money in bank accounts because they're going to get higher rates outside the banking sector, and there's going to be outflows from the banking sector. Now, this was very important, as these authors show, starting in 1978, but it's not going to be important in our setting in 1977, just because the ceiling rates on time deposits actually don't bind yet. You're still below the ceiling for the most part. So let me talk about the first two channels. So the net wealth channel. We look at some evidence supporting this. One thing we see is that higher inflation exposed banks, again, this is the fitted values in the second stage, have lower net interest margins, right? And if you decompose the net interest margin into the interest revenue and interest expense, it's because the banks that are more inflation exposed on the liability side, they're paying higher sort of rates because they have to pay market rates on their funding side. And then on the on the asset side, they're invested in sort of things like non-interest bearing cash and nominal bonds, which don't keep up with inflation. So their interest revenue is depressed relative to other banks, and that lowers their net interest margin. And we do some back of the envelope calculations to show that maybe this effect can, if you sort of plug in plausible parameters, can maybe account for about 2/3 of the lending contraction. Right? So the banks that are very highly inflation exposed, their ROE might be reduced from like 12 percentage points to about 10 percentage points. And we do some calculations showing what plausible effect that might lead on lending. Then in terms of the loan misallocation channel, we draw out from theory some of the predictions that this makes. In other words, if inflation volatility and inflation uncertainty increases, the main thing is that banks are going to shift away from long-term fixed rate loans like mortgages and invest in more short-term assets, like floating rate C&I loans, like shorter-term securities. And we're going to see that that's the case. The more inflation-exposed banks, for example, reduce their inflation exposure. They get out of long-term sort of contracts. They shift more into short-term securities that are interest-bearing. That's what that negative coefficient means. And also, the effect really tends to be in mortgage loans. So we see that the reduction in lending is sort of more in loans to households. These are mortgages. We don't see a significant effect in C&I loans, which tend to be short-term floating rate loans in the US. Okay, and then in terms of the deposit outflows channel, the main thing we show is that this wasn't sort of relevant in this period. This is not to say it's not very relevant in other periods. It's just that the regulatory ceilings on time deposits didn't bide. So if you look at 1977, you don't see really any aggregate outflows, that are sort of different from the trend in sort of, aggregate deposits. The real outflows started in 1978, which is when the regulatory ceilings started to bind. You could also sort of see this here from an old graph. This is sort of the ceiling rate. These are money market rates. The rates didn't go up substantially above the ceiling until after our sample period. So that kind of explains why the deposit outflows channel, is sort of starts a year later, but it's not the main mechanism in the natural experiment that we study. And then the last thing we look at is real effects, right? So we're looking across states, right? In some states, the non-member banks have higher reserve requirements that induces them to have higher inflation exposure. They reduce their lending. In those states, do we also see real effects? And we do. States where have more inflation exposed banks, we see a reduction in employment growth, but mainly only in construction employment. And then we don't see a reduction in total state GDP, but we do see a reduction in house prices. So again, this is consistent with evidence that the main contraction, the main effect sort of really targets the housing sector, which is consistent with a lot of other work on monetary policy and banking channels that really tends to target housing and construction employment. So let me just end there. Just to conclude, our paper proposes and tests a banking channel, which we think is sort of a main channel that macroeconomic policymakers should think about. Higher inflation, both in emerging economies and in advanced economies, leads to disintermediation. It hits the banking sector hard. That leads to reduced lending, and that has real effects. We look at historical correlations, across a variety of countries, and then we do this natural experiment to establish causality in the US in this 1977 experiment. So thank you very much.
Okay, great. Well, thank you very much to the Central Bank for organizing this session and for inviting me to discuss this really interesting paper, which I very much enjoy reading and thinking about. And it's really a formidable paper and difficult to cover maybe in 10 minutes. So I'm going to skip through and not summarize what you've already just seen, but just to say, of course, this is a very timely question, given what's going on in the world today in terms of inflation and the effects of inflationary episodes is, of course, something that, policymakers are very interested in at the moment. So because this is CEBRA and policy focused, when I was reading the paper, I was thinking about policy implications and what we could take from this. And I think when we think about endogenous variables, movements in endogenous variables like inflation, we usually think of them as arising from some underlying structural shock. So aggregate demand or aggregate supply shocks. And when we have an aggregate demand shock that increases prices, we would then expect an increase in demand for credit, generally speaking. Whereas if we have an aggregate supply shock that increases prices, well, we might expect that to have a dampening effect on demand for credit. And what the authors, I think, argue that they find in this paper, or that they've identified in this paper, is an energy price shock. Essentially an old school cost push supply side shock. And in terms of policy implications, I think you might expect that the response from the banking sector might be different to different types of structural shocks. So what we have here is one type of shock and policy implications that can be drawn from the paper for that type of shock, but maybe it's hard to generalize to inflation shocks in general. Moreover, we've had many energy price shocks over the 45 years since 1977, and one might argue that you'd like to think that maybe you could identify energy price shocks, more energy price shocks over this period of time to gain a slightly larger sample, and it might be difficult to draw policy conclusions from one episode 45 years ago, and having sort of a broader sample of energy price shocks might widen the policy impact of the paper. But of course, this is a little bit unfair given the exact identification strategy that the authors use. Finally, as Matt said, the paper identifies an energy price shock, and does so based on sort of readings of the FOMC by Castle and others. But if you, I went back and read the minutes from that period from early 1977, and it seemed like to me that the FOMC was quite focused also on energy prices, or energy prices as well as food prices. So here's a quote from the chairman of the FOMC at the time. He's very focused on changes in different food, changes in the prices of different food items, and they seem to be quite focused on this. My reading of the minutes at that time. And here on the right-hand side, we can see, I just pulled out the food and energy components, and you can see that there is like a large increase. It's basically coincident with the energy price increase as well. It doesn't look like it's in some way a second round effect or anything like that. It seems to happen at about the same time. So is it exactly an energy price shock that you're identifying, or is there maybe something else going on as well? My second kind of comments relate to the measure of inflation. So what the methodology does is basically compares member and non-member banks within states. And so this effectively differences out state level characteristics. So we don't need to worry if this is an energy price shock, that some states have a particularly cold winter and some states don't, or some states are really energy intensive industrial states, whereas others aren't. These characteristics basically, as I understand, get differenced out in the methodology. But I think that state level inflation is probably still important. So the identification, as I understand it, basically says there's a 2% inflation shock in 1977, and then takes this as given, and then it runs the first and second stage equations. But if we have the second stage equation here, and we think about an energy price shock that doesn't lands heterogeneously across the country, say half the states experience essentially zero inflation, and half the states experience 4% inflation, so that it averages out at 2%. I'm not sure what this does for the interpretation of theta here in the second stage equation. And on the right-hand side, again, I just pulled out the city average change in the CPI inflation between January 77 and January 78, and then two cities that came to mind, Houston, Boston. And we can see that the state level, at the state level, the inflation rate is very different from the US city average. And I guess that must mean that some cities have an inflation rate that's much higher than the US average, and you can have quite a significant variation in the inflation across different states. Now, of course, the authors have a discussion in the paper as well, where they discuss whether it's actually the national inflation rate or the state level inflation rate that might be important. But if it is the state level inflation rate, then there do seem to be significant differences. And Matt didn't go into it, but in the paper, there's a non-identified analysis from 78 to 2009, which kind of looks at the correlation between inflation and lending responses. And in that analysis, they find that it's the local variation in inflation that best explains that average lending response rather than the national inflation rate. Finally, the reserve requirements come from a paper by Gilbert and Levati, which is really interesting. They go into a lot of detail on reserve requirements for member and non-member banks during the period, which is not something that is not necessarily my area of expertise. But reading that paper, two things came to mind from what they talked about in that paper. First was they mentioned that the enforcement of reserve requirements for non-member banks differed across states. So, like obviously there are technical differences in how banks are meant to meet their reserves requirements across states, but also they kind of implied that there might be a posted reserve requirement for a state, but whether how strongly that reserve requirement was enforced or the time horizon over which it had to be met might vary across states. And I wondered what this might mean for the identification, if anything at all. And then the second thing that they mentioned was just that in the decade up to 1976, that a fairly large number of banks had opted into becoming non-members from having been member banks, and that they did this primarily because of the cost of reserves. And if banks are sort of choosing to become non-members because of the cost of holding reserves, I wonder what this kind of says about their risk appetite, if they're in some way different from the other banks, if this affects the treatment impact as well. So thank you very much. Really enjoyed the paper, and those are my comments.
How do you want me to do this? Should I respond to the discussant quickly? Should I ask questions or whatever? I'd like to respond. Okay, well, thank you for a very nice discussion. A lot of good comments, and we'll sort of take them into consideration as we revise the paper. One thing I just want to make sure that was sort of clear, maybe it wasn't clear in the paper, is that we're really careful to make sure that the effect on banks is not due to the oil shock, right? It's due to inflation, which leads to the repricing of financial assets on bank balance sheets, which then induces, right, the lending contraction. And so there are a variety of things we do to make sure it's not the oil shock. The first thing is that, we do have an identification strategy that looks across states, and there's no correlation between reserve requirements and oil, right, and sort of oil exposure, let's say. In fact, we could sort of exclude states that are like big oil producing states, the result of oil. Furthermore, our identification strategy actually differences within states. So we're looking at non-member banks versus member banks within states, so any state level characteristics are different now. And we do a variety of other things, we control for different oil exposure measures, but the net effect is, I want you to think of this paper as not a paper about sort of how oil might affect, all these contaminating factors. It's about the repricing of balance sheet items due to the increase in inflation expectations that originally are due to the oil shock. So, that's how you should think of the paper. A lot of good other ideas. So thank you very much. Let me take questions at this point. I could talk about some other issues. One other issue that Rebecca brings up is enforcement, right? Our reserve requirements enforced. And so we look at this. I think it's sort of buried in appendix table way in the back, but we actually graph banks and their sort of reserves and how they match the reserve requirement by state. And we find that this is basically binding. In every state, you have different reserve requirements. All the reserves are always above it. There might be, out of thousands of banks, sort of one or two banks that are slightly below it. So maybe there is some lax enforcement in some states, but for the most part, we just show visually that these different reserve requirements have really big effects on the cash holdings of banks. So we just think they were binding for whatever reason.
Yes, I do have a question. So it's interesting because there's no interest rate for like monetary policy response. So how should we think about the repricing? Do you think is there like some anticipation of future interest rates that's driving it? Because in some sense, like it has to go to the interest rate.
Yeah, so it's about inflation expectations. So the way I think about it is that nominal rates do go up in this era by 2 percentage points, 1 for 1 with inflation, but the real rate stays unchanged.
Oh,
so the way you should think about it is nominal rates go up for two reasons. One is because the real rate goes up because of monetary tightening. The other is because inflation expectations are priced in this period. So this is the period actually when the Fed didn't tightly control rates, right? So rates were allowed to endogenously float around a little bit. And when inflation rose up, nominal rates, according to Fisher's law, got pushed up by 2 percentage points, and that led to repricing. But not just sort of in short-term interest rates, but you can imagine that banks would reprice, their loans and deposit rates across different markets according to inflation expectations. So the idea is that, loan pricing, deposit pricing got repriced due to inflation expectations, right? So it's a shock to inflation expectations, not a shock to yields. That's sort of the idea.
That's when you said no monetary policy response, but
Yeah.
it to me that the nominal rate was still going up.
Yeah, the nominal rate was going up, but the Fed, the New York Fed, the market desk was sort of not intervening to the target rate. The FOMC was not sort of changing its target policy. They were not adopting a sort of an anti-inflationary tightening stance until a year later. So that's fine. The nominal rates did go up 1 inflation.
Still, I'm struggling with this notion of a natural experiment here.
Yeah.
How do you define natural experiment and why does it fit here? Don't we think of natural experiment as, something happening completely unrelated to the economy and,
Well, you could, maybe it's just the term you don't like, but, I'm just trying to identify the effect coming from the rise in inflation expectations itself, rather than other things like the rise in natural rates or rise in oil prices. And I also want to make sure that we focus a lot on the cross-section things, that the differences in inflation exposure are not due to, it's not because inflation exposed banks that hold more cash also are different along other dimensions. So maybe you could forget about the term natural experiment if you want, but I would say we focus a lot on identification in this case. Please.
You don't seem to include uncertainty in the revised expectations.
Yeah.
And the reason I'm curious about it is because one of the early introductions of the financial intermediation decision making into monetary transmission models was done by Woodford and Correia and Stephan, where they introduced it increases the financial intermediary uncertainty. So they increased they reprice to include a risk premium to cover to compensate for that increased uncertainty.
Very much agreed. And I think that's one of the, well, I think that's implicitly in one of the channels, the second channel. It's hard to test directly. Like if we had really good survey evidence that sort of, ideally we want sort of survey evidence that measured sort of dispersion and inflation expectations and beliefs. There was some survey evidence, like the Livingston sort of survey evidence, and we looked at some of them, but it's just in the 70s, and it's hard to measure uncertainty. So theoretically, it's sort of part of the way we think about it, but it's hard to directly measure that in practice. But I wish we could. Am I out of time, or I have?
It's like one more if there's.
Are you worried about the difference between member and non-member bank within the state for your identification, or does it not matter?
We think a lot about it, especially this idea that Rebecca brought up, that there might be reasons why banks choose to be member or non-member bank. The main thing we do is we look at pre-trends. So we look at sort of lending pre-trends and other characteristics sort of in the pre-period. There's always going to be some concerns, but basically we're comparing, the main comparison is non-member banks across states, and then non-member banks also between member banks. It's a double difference. So if there is some sort of bias, it would have to be weird. It would have to be that high inflation. It would have to be in high reserve requirement states. There's a difference between non-member versus member banks. It's systematically true in some states and not others. So I think our identification strategy mostly deals with that and looks at pre-trends, but it can never be perfect. Thank you.
So next up, we have Stephan from Neuchatel.
Thank you so much for inviting our paper and working with the session. So it's a joint work with Markus, Sergio, Emil, and Tom. And Sergio and I have the Fed, so we have to, our disclaimer applies. So this is the debt inflation channel of the German hyperinflation. So the first slide has some familiarity after Matt's talk. There's a very similar motivation. So what are we interested in this paper? It's a very basic question, if you want. We want to understand how inflation, particular high inflation, transmits to the real economy. And what we're having in mind is something more of a financial channel rather than a sort of a standard and Keynesian channel, sort of something that goes back, if you want, all the way to Keynes or Fisher even earlier. So what we have in mind is very well understood intuition that if there's an unexpected increase in the price level, unexpected increase in inflation, there's going to be some redistribution between creditors and debtors. And to the extent that if for households, if a household would be financially constrained and then its financially constrained would be reduced, the household would consume more. Or if you're a firm and you'd be financially constrained, if there's a positive shock to inflation, you'd be less indebted and your financial constraints would be relaxed. So that could potentially have real effects. And our paper is going to not so much thinking about households, but going to be thinking about the firm side of things. And as I said, this kind of goes back to even Keynes. We're writing sort of real time about the German hyperinflation. It's the flip side of it is in Irving Fisher's debt deflation, where it's the opposite. You know, there's a negative shock to the price level, then leverage shoots up, and it's going to increase financial constraints, tightening more. And it's also in some, if you read Kiyotaki-Moore is of course a real model, but Kiyotaki-Moore has a footnote where they say, you could have easily a nominal extension of the model where this exact mechanism would be in there. And then some other folks have actually written quite really nice papers that sort of formalizes these mechanisms. Why am I talking so much about this? There's a lot of theory, a lot of intuition for this financial channel of monetary transmission. There's actually not that much empirical evidence. In part, potentially, because it really only matters when there's high inflationary shocks. And we really didn't see those in the last 30, 40 years when we have most of the data that we study. So what we do in this paper, we go back to a really iconic event in economic history and study the German inflation of 1919 to 1923, which is sort of a massive shock to the price level, and then try to track down its real effects. Now, let me give you sort of this is a 20-minute talk, so I can't really do justice to giving you all the institutional and historical details on this particular event, but this is really, as I said, an iconic event, if you want, as it was something that had not been experienced before in world history. So what we're looking at, I'm going to try to just summarize it in one slide very quickly. On the x-axis, time running from 1914, from before the World War, the First World War to 1924, early 1924, when the inflation ended. And this graph is going to have two y-axes. On the left y-axis, I'm just going to have the log scale price level normalized to 1913-14, and then I'm going to change the scale going from 1 to 10 to the power of 12. Okay, so what you want to think of this episode is there's basically three phases. The first phase runs from the beginning of World War I to the end of World War I, which is a phase that's not very specific to Germany. What happens, all the major economies leave the gold standard in the light of the war, start to, if you want, print money to finance the war, to finance the deficits, and the price level eventually starts to go up as there is less goods and more money. So this episode is very common to all the major economies. Germany's price level goes up by maybe 2.5. The British price level goes up by about the exact same level. Then the German event, the German experience is a little bit different than the other countries, major economies at the time, that all the other major economies try to get back to the pre-war gold standard, try to disinflate. In Germany, inflation continues. And you have the second phase of the inflation, which runs from the armistice until the assassination of the foreign minister at the time, Rathenau, in which I'll get to it in a second, is a core event. But in this time, basically, the price level increases by, a factor of, between 70, 80, depending on you look at wholesale prices or the cost of living index. But in this phase, you see massive increases in the price level, but you also see periods of deflation. There's a lot of uncertainty that the price level sort of slowly starts to creep up and starts to creep up faster and faster. What happens and this is the third phase of this era, is basically the assassination of this foreign minister and sort of the total collapse of the currency, self-fulfilling expectations, and then the price level getting totally out of control. So what's causing this inflation? What's causing this problem in Germany? Well, if you want really the most simple explanation would be there's sort of some kind of major fiscal issue in the sense that the government is not really able to cover its expenses. And these expenses, to some extent, are reparations from World War I, but it's also a newly implemented democracy that's quite progressive. There's a lot of transfers that are being promised, but there isn't really a willingness to tax, especially the certain parts of the elites of the country are really opposed to that. So that just basically leads to this consensus that you're just going to pay all the bills and you're going to do it by printing money. In some sense, if you want, the politicians at the time, what they're really worried about is something like the Bolshevik revolution happening in Germany. They're saying, oh, we're just going to print money unless otherwise we'll have a revolution. So what we're really interested in is this interim phase before inflation spirals out of control and all these inflation expectations become self-fulfilling. And that's going to be sort of what we're going to be focusing on in this paper. Why is this the interesting part of the inflation? Well, it is because in this second high inflationary episode, inflation expectations are surprisingly anchored. Okay, so we don't have a very good measure of inflation. Yes, Markus.
Just real quick, in the previous slide,
yeah,
you see a break after the reparations were scattered, right, in inflation, right? Inflation started to rise, yeah, right?
Right here? Or here?
Yeah, right.
Yes.
Exactly, yeah. What was there a change of government? What happened there? Because it seems clearly a change in policy.
Well, there's actually a lot of there's more things that are happening. There's actually around this time, another famous politician gets assassinated by right-wing terrorists. And sort of that's the first time when they kind of realize they're not really going to be able to do credible tax reform. And at the same time, the reparations payments are being finalized, and it becomes clear that that's going to be a massive
Thanks.
So what's interesting is that we don't have good survey measures of inflation expectations for this episode. It's hard to come by. But what we can do is we can look at the forward exchange rate premium from the German mark to the sterling. And what's really striking is throughout this second phase, where the inflation is really high, inflation expectations are actually kind of anchored. In fact, the premium on the forward exchange rate is going to suggest deflation. So throughout this episode, people are looking at the price level and expecting deflation. In fact, it's in line with a lot of narrative evidence that you have on this episode. Keynes, for instance, was betting on the appreciation of the mark continuously. He lost an equivalent few millions of today's dollars in this. You have households in Scandinavia that are buying German marks, betting on the appreciation. The idea just basically being Germany ended World War I with a territory larger than it began it with. None of the capital, industrial capital was destroyed. And basically this change in the price level was looked to as like sort of a, team transitory style event where, there was some issues related to the war, disruption from the war. Eventually, then, as this, around summer 1922, it becomes clear this is actually not the case. And then you see this unraveling. You have really self-fulfilling inflation expectations. So why does this matter? Well, in this interim period where inflation is really high, bank credit actually is quite abundantly available. Then this later phase, when our papers is not so much about anymore, really credit as a credit crunch, unanchored expectations and a flight from the currency. What's quite striking is, so Alan unfortunately had to leave. I'm using his data, really nice data on GDP for multiple countries around this time. You see the German experience after World War I is actually very different than most of the other major economies. The German economy throughout this period is booming compared to everyone else. In the US and in the UK at the time is going through a phase what at the time they called the Great Depression because it's such a huge contraction. Later, it's of course revised, but Germany is going through a boom. That's not to say people are happy, people are extremely unhappy, but everyone's working and industrial output is high until the inflation expectations become unanchored and then the inflation becomes hyper. Now, what do we really do in this paper is we're going to try to bring some novel microdata to the table to try to understand some of the economic forces that are underlying these macro trends. So what we're doing is, and this was quite some data effort, we built sort of a CompuStat equivalent for the interwar German period from 1914 to 1933. In this paper, we're focusing on the hyperinflation. But basically what this is a source called Zahlungsbörsenjahrbuch. This is an investor manual available at the time where firms would report the balance sheet, they would report the income statement, they would report the number of employees, at least some of them, and they would report other details on their financial structure. For instance, they would report the contractual details if they had long-term bonds outstanding. So we digitized this data. It's a very long year effort. If you read German, you'll see this is for Siemens, what it was at the time. This is its balance sheet and income statement. You'll see these balance sheets are non-standardized listed items in the text. So there's quite some effort to actually digitize it and then standardize it. But we're not only focusing on balance sheets and income statements because they may become unreliable as the price level creeps up. So we're going to mostly study real effects. We're going to look at employment, which, as I said already, I think is reported for a subset of my 700 main firms. We'll look at stock prices, which are real by definition. We're going to exploit that after the hyperinflation, all firms are required to mark all assets to market in a new currency. So here's some of the main results. One of the first findings that we have, if we just look at the leverage of firms before and after the hyperinflation, you see there's a massive deleveraging. So this is the distribution of liabilities. So that's basically all financial debts, but also other liabilities that are nominal, such as pensions, over total assets in 1919 and in 1924. You see there's sort of this massive shift where basically firms from before the hyperinflation, after the inflation are basically very much less debt. In fact, something we don't have in the paper, but we found later after finishing the first draft is that the firms actually during the hyperinflation, to the extent that they're able to prepay long-term bonds, they do that, cents on the mark during this inflationary period. Now, if you look at the income statements, just aggregate it up, and you look at how much of the resources that the firms are spending over a given year, a given fiscal year, how much are they allocating to interest, so servicing debt, how much are they allocating to production, so that's paying workers, that's purchasing raw materials. You see what's happening through the inflation period. The amount of resources allocated to interest declines substantially, declines by something like 60%, or I think it's about 9 percentage points, but it's equivalent to 60% decline. Production expenses, on the other hand, go up. So that's sort of in line, at least with the cash flow constraint being somewhat relaxed. You have to have less resources available to service debt, and you have more resources available to produce. Here's the second fact. During this, and there's sort of yet another piece of evidence that from the aggregate data, that financial frictions are being relieved, is basically here on the x-axis. I'm plotting inflation over the last year and wholesale prices, and then the number of bankruptcies in a given quarter. And you'll see something like basically when inflation goes from 0 to 50%, you see a very steep drop in bankruptcies. And after that, this is sort of this nice convexity. It basically just flattens out. Once, intuitively, once there's been one or a sufficiently large number of inflationary shocks, no debt is basically left. There's no leverage left, and then it doesn't really affect firm bankruptcies anymore. So this is the number of bankruptcies. You can also do this with the rate of bankruptcy, and you'll arrive at a quite similar insight. Now, if you want to think about New Keynesian frictions during this time, you want to think about how flexible are prices, how flexible are wages. I'm going to plot you here is just the decline, the interval between in terms of time that it takes for a wage to be increased and how much time elapses between a retail price is being decreased. And this is averaging across a number of industries, union bargaining wages, and this is averaged across a number of representative prices in cities, some microdata that we connect. And quite intuitively and in line with sort of a menu cost model, once the inflationary shock is large enough, you'll see that wages essentially become flexible. They become updated. They are increased every 30 days or less. So our data is at the monthly frequency, so we can't really tell you whether it's even more frequent updating. And sort of the same is true for prices. So intuitively, what's going on is, once the inflation, exceeds 50%, 100% or so, essentially wages become indexed, and essentially prices become indexed and adjust very quickly. Now, keep in mind, though, financial contracts, especially long-term contracts, nominal long-term contracts, cannot respond in that same way, right? So whereas a worker, once inflation is high, can just go and say, well, I'm not going to work anymore unless you pay me more. You don't have really, as a bank, any legal recourse to go back to your creditor and say, hey, now that there's inflation, I'd like you to repay me a higher amount. Now, really, what's the core of the paper is this microdata I was referring to, and then exploiting the cross-section in this microdata. So what we're going to do is something like if you want a difference in difference type of regression, where we're going to have some firm level outcome in a given year. We're going to regress that on the firm's leverage at the onset of the inflation. So that's sort of, in some sense, the ratio of liabilities over assets, or the ratio of financial debt over assets, in some sense being sort of a measure of how treated you are. Okay. Now, of course, leverage isn't randomly assigned. This is not, we don't have any good instrument for leverage. So the identification here is, a little bit weaker, as if, if you had some good instrument. Really what we're doing here is we're running a difference in difference regression that's sort of the identifying assumption, pretty strong assumption is parallel trends, being that firms with different leverages would have behaved the same through that business cycle if inflation had been absent. Okay, but really what we're exploiting in some sense is that and we do much more in the paper, is that it's actually pretty hard to explain what governs a leverage, at least once you go into some, a smaller unit of observation, say within industry. So, there's going to be some explanation size that we can capture, but then there's going to be some considerable residual variation that you really can't explain. But, this paper doesn't have sort of a home run identification strategy. Keep that in mind. And, we do a lot in the paper to really try to address the concerns that you can have, but you can always remain skeptical if you want. But let me just show you the results. So the results are first, again, let's think about interest expenses and production expenses. So how much resources are you allocating to servicing debt? How much are you allocating to production? Now in the cross-section, you're seeing a similar pattern. You're seeing essentially that those firms that had more debt at the onset of the inflation, they're going to pay less interest, they're going to pay more of the expenses that they have in total on production. Okay, so that's sort of again in line with there is in the cross section some differential effect on how financial constraints are being relaxed. Now let's look at employment, and before I show you the regression output, you can just look at the raw data. I'm going to group my firms into by their leverage before the inflation into three groups, three terciles: low, intermediate, and high. And I'm just going to plot their employment throughout this episode. So first takeaway is all firms are increasing employment. So that's sort of in line with the fact that the economy is booming. All firms are hiring more workers. But you're seeing this effect is way more pronounced for those firms that have more debt and more liabilities that are nominal outstanding at the onset of the inflation. Okay, and so you see maybe a 10% increase in employment for a firm that has low leverage in the cross section, and you see a maybe 30% increase of employment at a firm that is having a high degree of leverage. You could do this in a regression. You can, throw an industry year fixed effect if you're worried about, differential exposure to the exchange rate and imports, exports. You can have all kinds of control variables, and we can sort of exploit that. We know the connection to the bank of the firms, and you can sort of, if you think about Matt's paper and the effect on credit supply that inflation must have at some level, that can arguably sort of, control for that if there's sort of differential effects on credit supply. Okay, so we do a lot to kind of, try to verify that this is a robust empirical pattern. Now, let's think again about the mechanism that could be driving this. There has to be some kind of redistribution. So to get to that, we're going to look at stock market returns. Any sort of simple theoretical model on this issue would predict to you that the stock value of those firms that had more debt should go up more. So what you're going to see here, and I'm going to do quintiles. I'm going to group there are 5 groups of firms, and then I'm going to calculate their stock return. Those firms with low leverage and those firms with high leverage to the left and to the right. Okay, first takeaway is the stock market does miserably. On net firms, the stock market returns are really, really low. Keep that in mind when you think about the aggregate effect. It's telling you something about the intercept in some sense, because everything else I'm showing is about the cross section. But so there's some big puzzle here. Why does the stock market, even though it's a real asset, doing so bad? But what you see is the difference between high and low firms, high leverage firms and lowly leverage firms, is considerable and statistically significant. So you can sort of basically make a return by going long on the high leverage and short on the low leverage firms.
Can you clarify again? Total return. So is this already measured in real values or in?
That's in real values. That's right. Yeah. Yeah.
Okay. So nominal values went up, but not.
Yes, of course they go up in the billions. Yeah. So that's in line with some redistribution from debt to equity holders. Now, sort of the most convincing the most convincing piece of evidence that I have in terms of nailing down the identification is I'm going to exploit some of the contractual. How much time do I have? Do I have 2 more minutes? Or some of the information that we have on the contractual details of the bonds that these firms are issuing. So some background is that in this period before the First World War, you're going through an episode in which 50 years, 60 years of enormous price stability. Hyperinflation is unheard of. The last hyperinflation was in the French Revolution. That's not the modern economy. So in this episode, this is not just a German phenomenon. Firms are able, and governments too, are able to issue bonds within really, really long maturities. So a lot of these firms in my data, more than 50% have bonds, and these bonds have really long maturity. So what I'm plotting you here is for the year 1920, I collected all the origination years, repayment start years, and repayment end years for these bonds. You see there's a lot of bonds that were issued before World War I, and they have maturity in 1920 up to 1970, 1960, some of them, okay? So these bonds are basically issued, and there's a 5-year interest only payment, and then there's sort of a continuous amortization. The median repayment end year is 1940, according to these amortization schedules. Now what I'm going to do is I'm just basically going to compare 2 firms have the same amount of debt, but one firm has more long-term debt than the other firm. And this long-term debt, having been issued way before World War I, kind of tells you something. It's not going to be issued as a reaction to the events that are going to unfold after World War I. But you're going to see then, if you do this kind of exercise, if you look at the result with respect to interest expense shares, I'm going to give you the average here. You see, really, this average is driven by the firms that have the most outstanding long-term. So it's really this result's coming, if you want to understand the underlying heterogeneity, it's coming from firms that have a lot of long-term debt. The same is true with respect to employment. This employment effect that we're seeing on average is really driven by the firms that have a lot of long-term debt outstanding. Okay, so you have to think of a firm having a 50-year maturity, fixed rate, nominal bond. Then this inflation comes. Of course, this bond is gone. It's going to benefit way more from a firm that's just having some trade credit. Okay, so let me conclude here. So what we do in this paper is we study a really big inflation, a massive shock to the price level to understand how the redistribution from net debtor firms towards net debtor firms can have real effects. And think of a macro model with the friction being that there's for some reason, long-term nominal debt that's fixed rate, or to the extent it's floating rate, there's no policy response, and some kind of reason why these firms are financially constrained, then you can generate these effects. Our model doesn't really speak to aggregate effects. So this is basically partial equilibrium if you take these cross-sectional estimates serious. So you want to think about the fact that there are other forces that are, of course, driving aggregate output. For instance, if you think about Matt's paper, there's going to be a negative effect on credit supply, which should sort of offset some of these positive effects. So, we can't really say anything about welfare effects. It's very much ambiguous. External validity is always an issue. If you really want to, you could say none of the stuff that happens in Germany is in 1920 could tell you anything about what's going on right now. And then, if I would push back maybe, but even if you don't do that, just think of the fact that this episode has sort of really been informative for, major macroeconomists like, from Sargent, Keynes, Dornbusch, etc. So what's really nice is if you actually have the microdata to go back to study and understand this kind of event better. Even if there's very little external validity into it, it's still, I think, really interesting from a purely academic point of view. Okay, thank you very much. I look forward to the discussion from Björn.
All right. Thanks, David, for inviting me to discuss the paper and finally read it. Very interesting paper, as Stephan said. It's about an iconic historical episode. And I think the smart idea to do with this episode is to write a paper about it. What I'm usually doing is to drop this data. So this is from the paper I'm going to present in a second. But we are usually scared that this is like a massive outlier, and we don't want to destroy our results. So there's one episode in history that we are actually dropping, and it's exactly these 6 years that you are studying in this paper. So yeah, it's very nice to learn about this episode, and maybe I don't have to drop it in the future. So yeah, summing up, or what these guys do instead of dropping the data is they exploit this iconic historical episode as a interesting laboratory. It's a well-known episode of high or even very high hyperinflation. And this means that the inflation channels, whatever they may be, are particularly prominent, important. And over most of this period, inflation was unexpected, which is also nice for exploiting this data. I'm pretty working with historical data myself. I also like that you bring new data to the table. There's aggregate series on price and wage adjustments and very interesting data on bankruptcies at the aggregate level. And then there's firm level data newly digitized for about 700 listed non-financial firms over a 10-year period. And then the authors use this new data to study basically in the aggregate, the relationship between inflation and some business cycle variables. And then the more interesting part is looking really at the firm level outcomes. What do firms do in this episode? So very short summary, I think you presented almost all of these results. At the aggregate level, you find that high inflation is associated with a lower share of interest expenses and total expenses, and with lower default rates of non-financial firms. And there's a strong decline in leverage over this inflationary period. And then at the firm level, basically sorting firms into two different bins or several bins by leverage measured before the inflation, you find that ex-ante highly levered firms increase employment relative to low leverage firms, and that these levered firms also experience higher returns to stockholders, lower interest expenses, and a larger decline in leverage. How do we think about this? You could think about this in terms of a simple balance sheet where you have assets, most of them real, and then you have nominal debt, and the difference between the two is net worth. And if now the price level is fluctuating, then this means, depending on how you view it, that the nominal debt, if the price level increases, nominal debt will decrease, meaning that net worth, the amount of the shareholder or stockholders share is increasing. So this is kind of the traditional channel that, as you said, has mostly been associated with the debt or with deflation, not so much with inflation, where the price level changes the distribution of income between creditors and debtors. Here, it's more a redistribution between creditors and shareholders. And then, depending on your view of the firm, this might not matter in a Modigliani-Miller world, but in a world with financial constraints, this net worth or redistribution to shareholders might matter. And my comments are basically building on this simple balance sheet. The first one is about nominal assets. So I think you put up a balance sheet just a few minutes ago, and there was a lot of nominal assets in the balance sheet as well. I think it would be interesting. I don't know whether it's possible. I guess you thought about it. Maybe it's hard to do. It would be interesting to know what is the amount of nominal assets in these balance sheets, and to exploit it in addition to your leverage measure, which is basically a measure of how much of nominal debt relative to total assets do we have, exploit as a second dimension of exposure to inflation using the share of nominal assets in the balance sheet, or this would, I mean, I'm coming to Matt's paper in a second, but something like net nominal assets or net nominal exposure or exposure to inflation at the firm level. This could be potentially interesting. As I said, what is like the extreme form of a firm having a lot of nominal assets is a bank. Now, banks have a lot of nominal assets. So in the case of banks, it's probably the case that they even have a positive net nominal assets. Banks, you have the graphs in your paper somewhere, lost a lot of value even relative to non-financials. And based on the aggregate data that I was collecting at some point, I remember that book leverage actually increases for banks. So exactly the opposite what we see for the non-financial sector. So it will be interesting to look at bankruptcies in the banking sector. And I have the feeling you're going to write another paper about exactly this. It sounds more, based on the channels you're describing, it sounds more like you will be thinking about how this is affecting credit supply. So banks are losing in this episode based on being connected with a bank that is losing. What does it mean for firms again? That was kind of my interpretation, what you might be doing. But I think even here you could include it as a kind of cross-sectional argument. It's another type of firm, and it's very, well, differently exposed to inflation compared to these other non-financial firms. So this is part one of my comments. And the second part is basically about the timing of things. You were now talking about re-inflationary periods, taking the World War I into account. I would think of two inflationary periods, kind of the 1919, 1920 inflation, then a short period of stabilization, and then hyperinflation starting in 1922, 1923. And much of the real effects seem to come or seem to be based on this first inflationary episode, the years 1919 and 1920. And what I was wondering about is, why would this episode have these large effects, while the later episode with a much higher inflation doesn't seem to have these effects? And I think there's, as you showed us, one channel could be that in the first inflationary period, this was unexpected as compared to expected inflation later on in the second half of this sample. It could also be that leverage of firms was already low. So the advantage of the debt burden being reduced through inflation might not be that strong. Or it could be maybe what you are doing in the second paper, that credit supply is already impaired, banks are not lending, or if they are lending, these contracts are adjusted kind of for inflation. And one smaller comment about the timing, I think this should be considered a bit more carefully in your specifications. You have many specifications that are based on the 1918-1990 average of leverage, but then 1919 is probably measured in December 1919. And I think there was already a lot of inflation until December 1919. So yeah, just for potential referees to convince us, I would probably go for a 1917-18 average of leverage for robustness or something like that. So summing up, I think it's a great paper, new data on, as I said, a fascinating episode showing that unexpected inflation may have some positive effects. I think the general equilibrium consequences, once we, as you showed us with the stock market data, I think once you think about all potential channels, this result might change, but at least from this perspective of financial constraints in the non-financial sector, there seemed to be a positive effect here coming from inflation, relaxing financial constraints and allowing firms to grow. I'd like to know a bit more about especially the role of nominal assets and firms being differently exposed on the asset side. And I think, as I said, I think you're going there. It would be super interesting to know more about what banks are doing, how, I mean, banks are the ones losing, not getting repaid in real terms. So yeah, I'm very much looking forward to, I guess, your second paper on this.
Thank you so much, Björn. A very nice discussion. I think you're spot on all your main points. So I think we'll have to do a little bit more with the nominal assets. I think we have somewhere in the appendix some. Well, so let me just explain a little bit when we have to basically classify these balance sheets. Every firm just writes whatever it wants in its balance sheets. It could say like, oh, my brewery in this city and my horse in this town, and then value it. And so we have to kind of standardize these, and we focused, naturally first on the liabilities. I think we did some job with assets, and we have something in the appendix, just broadly cash. But I think we would have to, we could do that more. And the second point I think is, I think I tried to mention it as well, and you put your finger in the wound, is you want to understand the effects on credit supply. There's sort of, there are winners, that's the firms that have a lot of debt, and then there are losers, and then that's going to happen. I think Matt's paper speaks to a lot of these issues conceptually already, and is sort of the framework to think about, a framework to use to think about these kind of questions. And I think on top of that, there are other negative forces on output. Just the misallocation that comes from the fact that prices are updating all the time. But eventually at the hyperinflation, what you're seeing is that basically every day at noon the price is being the exchange rate is being determined, and then a trade happens within the next hour or two and then dies down. That's just massively inefficient, and there's a lot of misallocation. So all of that's going to be dragged from GDP. So I think it's just, yet again, I want to say we abstract from all these other channels, not just the credit supply channel. But let me take some questions with Marco. Yes.
Yeah. So can you put the kind of the two papers together in the sense that they're not necessarily in contradiction, but they do send, as far as I understand, a slightly different message. Meaning the first paper says, well, firms, banks stop lending, and you would think that kind of is not great for firms where there is high inflation. Your paper, on the other hand, say, well, unexpected inflation is kind of great for firms because leverage goes home and bankruptcy go down.
Yeah.
Can you tell?
Well, I think, there is sort of the unexpected inflationary shock in a world where there are financial constraints that are keeping us from getting to whatever is, first and best, whatever you want to think about, is the inflation. One unexpected inflation is going to help us to improve the allocation, right? But then as Matt also thinks about in his paper, there is going to be some, so this is about stock of existing debt, but where it's not in a static model with an unexpected inflationary shock, the effect should be positive. But now, it's not just the one-off unexpected shock, but if there's sort of some shock to, let's say, the volatility of the price level, and then that down the road just contracts credit supply more generally, and it's going to help us.
Your result on employment kind of seem to.
So what I think you want to think about our evidence is that there is this massive initial increase in inflation, wipes out the debt, and that sets free a lot of resources. And to begin with constrained firms that have positive real effects. There's a lot of other stuff that goes along with that that's going to drag down real economic activity that we're not considering in kind of simple econometric frame. Yes, please.
To add to this, but this has to be also something to do with the fact why you get this inflation, where is inflation coming from?
Right.
You say you get fiscal policy expansion, so it's demanding supply.
That's right.
So this has to be some importance for you, that you don't control it. You might be asked that what I'm saying is that if there is unexpected inflation coming from a supply shock that also determines big recession, that might have very different effects.
Yeah. No,
even though they are less financial.
So I fully agree that the supply and demand are going to play out very differently in the economy, even in the kind of conceptual frameworks that we sort of have in mind. But what I do want to say is so this is what Matt was actually saying in response to Rebecca is at the end of the day, just the fact that the aggregate prices are going up and there are some contracts that were nominal and then there's going to be some redistribution. If you just isolate that effect, whether that comes from originally a demand or a supply shock that's driving up prices, that's going to have an effect on its own.
Okay, I understand, but my question was, you isolate that effect. So,
oh,
they're yes. Very careful doing that. But you just use inflation.
Yeah, we just use inflation. Yeah.
That's the.
It's obviously demand driven in Germany at this time. Yeah. Please.
So you argue convincingly that inflation was unexpected up until 1924. But 22, yeah. But then say, I wonder to what extent you need this if you also show that there's a lot of long-term debt out there. If that's issued in 1920, yeah, then you don't need this inflation to be unexpected.
Oh yeah, no, so I mean,
yeah. So what is really important? And that's my question. Is it the unexpected part or the fact that you have locked in the debt in 1920 already a long term?
So from a identification point of view, for my paper, I don't need inflation to be unexpected in 21 or 22 anything. It's yet interesting sort of because one of the things that immediately pops to mind is that you're going to have some confounding effect of credit supply drying up, and then that's potentially messing up with the resultant. So, you could come up with a story where you have firms that have long-term debt, they're not exposed to credit supply shock because they have, they're financed already. Short-term debt firms have to roll over. So then that could be driving some of the prospects for various. So I think on the one hand, it's just exciting to think about and to see it in the data in of itself. And then it kind of plays a little bit into our story, but it's not core. Yes, Matt.
So can you explain a little more in detail how the financial constraints actually affect employment? In other words, you have to think that these firms are so financially constrained in the first place that they're not at optimal employment, and when you release the financial constraints and they sort of pop back up, is this sort of a time when the firms are in, why were the firms sort of in deep distress? In normal times, removing the constraint shouldn't have been binding. Why was the constraint so binding?
Well, I'm not sure I would agree with normal times. I mean, just think you're off-the-shelf macrofinance model. You don't need a crisis for a firm to be constrained. You just want to expand more production. You can't because for some reason you don't have enough pledgeable collateral or whatnot. You don't have enough cash flow coming in, and you're not going to expand your operation. So,
or even in normal times, if you just wiped away the debt of a firm, it would instantly hire people.
Well, some firms would, yeah. Some firms will not hiring people because they don't have the resources. Yeah, the way you want to. I mean, that's sort of the macrofinance world. I'd say that's going to be much more of a problem in financial distress. I agree. And it becomes more of a problem in deflation, but it becomes less of a problem in inflation. Yeah. Any more questions? Yes, please.
Great paper, amazing data set. I'm just thinking about how to. So you find this positive effect on terms, but should I think of it as a short-term effect because you have this kind of small part of your sample before the hyperinflation starts, so you really don't know what would have happened if, let's say, in 10 years after such an inflation.
Yeah,
but it's just a short-term effect.
So in the data, it turns out that that you can still see the effects around 1925, 1926. So it's not super short term. It's not originally we had some data bug. We thought it would go down again, but actually it doesn't. So it stays at an elevated level.
So that's 6-7 years.
That's 6-7 years. Yeah. And you can't really do very long term because of course you have the Great Depression over the Second World War. But it's interesting concept. It actually tells you a little bit when you think about, is it a long-term effect or a short-term effect, it'll implicitly tell you something about what kind of constraints you are relaxing. For instance, the Q-Moore style model will have, I think, long-term effects.
Time for one more.
Oh, yes, sorry, yes.
So just a small remark, you show there are winners and losers, no? I think that in net terms, an important factor to consider is whether the economy, to begin with, is in a situation of over indebtedness, no?
Yeah.
Because then you would have a sort of a restructuring, that from inflation.
Yeah.
This could, let's say, determine the sign of the net effect, so to speak. So,
yeah, and there's a lot of historians have spoken about this. So this is called the, I think, clean slate theory of hyperinflation, where you just wipe out all the debts, including government debt, which is, important part too. And by that stimulate, well, you reallocate and potentially stimulate the economy. Yeah. Very good point. Thank you so much.
Okay, so back up to the front for his second job in the session. The Björn Richter from
Thanks, David, for allowing me not only to discuss, but also to present my own research. In this case, I'm winner and loser. Okay, so this is about monetary policy, inflation, and banking crisis. We started more with a focus on inflation. It turned into a monetary policy paper later. And it's joint work with Gabriel, Jiménez, Dmitry, Kuvshinov, and José-Luis, Peydró, and because Gabriel is with the Banco de España, the usual disclaimer applies. And the motivation is clear in the current environment of high inflation. Policymakers have to increase interest rates. I think we know a lot, at least more than about financial crisis, about the relationship between increasing rates and real economic activity in terms of GDP or recessions. But then clearly raising interest rates also has financial stability effects, and especially so after a period of very low interest rates for kind of long. And this is basically what got us thinking about the question, does it matter what the full path of policy rates is looking like before a financial crisis, or for the risk of experiencing a financial crisis? Not so much is it only raising rates or decreasing rates, but what does the rate of policy, the path of policy rates look before financial crisis? And we first turned to the data and just had a look at different crisis episodes. And I'm showing you here some famous early crises, some banking crisis in the 1990s, and then two countries in the global financial crisis. And the pattern you see is that for all these crises, the year of the crisis always here, you see that in the roughly 8 years, I mean, you can discuss, before policy rates were, looking at the Spanish case here, first decreasing and then increasing in the more or less 3 years right before the crisis. Yeah, so we looked at the data. We had the feeling this seems to be a general pattern. And so what this paper is doing is basically starting with these case studies and trying to make a systematic case out of this. So we asked, what is the impact of monetary policy rate dynamics on banking crisis? And what is the full path of monetary policy rates before historical crisis? Or put differently, what are the risks of raising rates in an environment where rates have been decreased before or were kind of low before? And then in the second step, as based on the case studies I was showing you, we will find this relationship. And in the second part of the paper, we are then focusing on the underlying mechanisms that link the rate of the path of policy rates to financial crisis. And we do this in a long-run historical panel using the Jordan-Schuler-Taylor database for 17 countries, going back to 1870. And then to tease out more about the mechanisms, we look at one particular case study and use Spanish credit registry data from 1995 until today to be able to say more about what's actually happening in these episodes. And what we find is, first of all, that raising monetary policy rates increases crisis risk, but it only increases crisis risk if rates were previously cut over a longer period. I will define this period in a second. And this, importantly, this is different for non-crisis recessions. Yeah, raising rates is often associated with a recession, but this path dependence that it's important whether rates were cut before or not, this is not something we observe for non-financial crisis recessions. And importantly, it seems to be something about policy rates. We don't find the same patterns for inflation or real rates or for long-term rates. So policy rates are short-term interest rates. And then in the second part of the paper, we look into the mechanisms, and we find that maybe not too surprisingly, as interest rates are cut in the first leg of this U, there's a credit and asset price boom, and then there's a reversal following as based in this environment of a credit and asset price boom, you start increasing monetary policy rates. And we do this by using a definition recently proposed by Greenwood and co-authors, who define financial red zones as being times where credit and asset price growth are high. And then we first show, as they do, that these financial red zones are associated with higher crisis risk. But in addition, we show that this higher crisis risk only comes from episodes where in this red zone, you start hiking monetary policy rates. Summing up, you basically need a combination of, we find that you need a combination of this U-shaped monetary policy and the existence of a financial red zone after a few years of decreasing rates. And then once you start increasing rates in this red zone, the likelihood of a financial crisis increases. And we find similar patterns when we don't look at banking crisis as an outcome variable, but at measures of bank performance, loan losses, and so on. And then we go into the Spanish credit registry to use fixed effects to account for demand and supply. And we find that a given loan is more likely to default when it was granted or originated after rates had been decreased. So rates are low at origination. After origination of the loan, rates start increasing. This loan is likelier to default. And this is in particular true for ex-ante riskier firms and riskier banks. Yeah, so there seems to be some lending to from risky banks to risky borrowers during these episodes. So let me, the data, I said it, 17 countries, 1870 to today. Let me just show you first the average in our sample. This is the short-term policy rate around financial crisis or banking crisis events. So the banking crisis is in year 0 here, and you see that in the years before, rates are first decreasing, they start increasing, and then after the banking crisis started, the rates are decreased again. And this is a very consistent pattern across crisis definitions. So we use Matt's crisis definition. We define deep banking crises, and we always see the same pattern of a decrease first and then an increase in interest rates. Again, this is not the case for other variables. We don't see the same for inflation or real rates, and long-term rates are much more stable. This means that the term premium has exactly the opposite pattern as the short-term rate. So the term premium is first increasing and then decreasing right before the crisis. And we don't find similar patterns for non-crisis recessions, which are much more closely linked to just an increase in interest rates. One way to do this, I mean, how do we do this in a structured, how can we show this in a structured way? The first thing we do is we sort the data into 4 different bins. I mean, there's only so many things interest rates can do. They can go up or down. And if we have 2 different episodes, they can go up twice, they can go down twice, or they can follow this U shape, as we call it, or a lambda shape, a raise and a cut. And we look at these or sort the data into these different bins, what interest rates were doing in the previous years, and then look at the probability of experiencing a crisis after each of these shapes. And we look at the following 3 years just to make sure, just in case we don't get the timing exactly right. And we find that after experiencing a U shape, the likelihood that the country will be in a banking crisis in the following, over the following 3 years, or in one of the following 3 years, is 20%. And this is much higher than the unconditional mean or any of the for any of the other policy shapes. And this gets even stronger when we look at the post World War II episode, and when we look at deep crisis post World War II, which were basically all preceded by such a U shape. We then try to put this into a regression framework and to also deal with some endogeneity of policy rates. So we exploit the trilemma, which basically means the open economy trilemma, which means that you have, once you're pegged and have an open capital account, you will be forced to track the interest rate changes of the base country. And we can use these base country changes, which we residualize for observable variation, as an instrument for interest rate changes in the respective country. And we then run a regression of the probability to experience a crisis in the next 3 years on, first of all, the change in interest rates over the 3-year window up to now, a dummy variable, just to make it simple for now, whether interest rates were cut in the preceding 5 years, and on their interaction. And focusing on the third column here, you see that an increase in interest rates is associated with a slightly higher banking crisis risk in the OLS specification. A cut, loose monetary policy or a cut in policy rates is associated with a higher crisis likelihood down the road. So this is a few years ahead. Yeah. And importantly for us, the interaction of the two is highly significant and positive, meaning that if you increase interest rates and interest rates had been cut previously, crisis likelihood increases. And you see, if we go from the OLS to the instrumental variable specification, that this coefficient actually gets larger, which you could kind of interpret as maybe as in the current situation, policymakers are kind of aware of this trade-off. So they might be reluctant to raise rates in these situations, but then the risk increases with these exogenous changes. We do a whole bunch of robustness tests for this. First, for the specification I was just presenting, using different samples, different time windows, and then also different measures, because it's kind of unusual to use the shape of policy rates to predict crisis. So we experiment with some other measures. We came up with how you could measure such a policy rate path and find very consistent results. Again, we don't find the same for if we do it in a regression framework for inflation or real rates. And also, and this is just to show you that this is something specific about banking crisis, we don't find the same patterns for non-financial recessions. So recessions not associated with the banking crisis. In this case, we see that increases in interest rates, as you would have expected, are associated with a slowdown in economic activity and a potential recession. But the interaction with what was happening a few years before doesn't matter. So this is the first part of the paper. And then in the second part of the paper, we are trying to go into the channels and understand why the path of previous policy rates might matter for banking crisis risks. And the idea, I was mentioning it before, would be that low rates or a cut in policy rates can create some financial vulnerabilities. Banking crises, as we know, are associated with asset price and credit booms. And as a result, there might be this relationship. So we define the financial red zone, which again is basically saying an indicator variable that is 1 if there's a high credit growth environment and a high asset price growth at the same time, measured as being in the case of credit. We just followed this other paper. In the case of credit, above the 80th percentile, in the case of asset price in the highest tercile. And we find first that a cut in policy rates is indeed associated with ending up in the financial red zone. So if rates are cut, so this is our cut dummy from the previous specification, if rates are cut between t-5 and t, then the likelihood of being in a red zone over the following 3 years increases significantly, especially so for large rate cuts. Importantly, for us, I mean, first of all, this is the result that Greenwood and co-authors have, that these R-zone events, now you can construct these R-zones for the business sector, looking at stock prices and lending to business. You can construct them for the household sector, looking at lending to the household sector and house prices. And what we use from now on is basically a dummy, whether one of these sectors is in the R-zone, but results also hold when we split them. And these authors find that being in the R-zone is associated with a higher likelihood of crisis over the following years. We show that, I mean, one of the conclusions could be that being in the R-zone, you should maybe try to deflate the asset price and credit boom. One way to do it would be increasing interest rates. We show that this is particularly dangerous. So the likelihood of experiencing a banking crisis increases if while you are in the R-zone, you start increasing policy rates. And this holds in the OLS and IV specification. We find that this is mostly true for the R zones created by previous low rates. If the R zone was unrelated to monetary policy, we don't find this pattern. Keep in mind, there's not so many R zones that are not preceded by low rates. And then just to look at the combination of the two, is it really important that you have both the U in monetary policy rates and the R zone? We sort the data again into 4 bins. Now, whether you have a U shape and an R zone over a given 8-year window, or one of the other 3 possibilities. And we find obviously this bin is now much smaller than the other ones because there's not so many observations where we have a U-shaped monetary policy and an R zone in an 8-year window. But once you're in there, crisis likelihood is 40% over the next 3 years. And this again increases or becomes even more striking once we look at the post-World War II period and look at deep banking crisis only. We find similar results when we look at other measures of bank performance. So this is now looking at bank stock returns and repeating our baseline specification. So bank stocks perform worse in these situations at the end of this U-shape. We also find that there's bank profitability measured as the return on equity is going down, or put differently, loan losses are going up. And this is the link to the second or final part of the paper, which I will not have much time to spend on, but where we look at Spain. Spain basically mirrors our identification setup in the aggregate data, because monetary policy rates over the period we are looking at are set in Frankfurt, not in Madrid. Spain has a very bank-dominated financial system. And then we basically look at the question whether a given loan is more likely to default if it was originated in a period characterized or preceded by a cut in policy rates, and then afterwards policy rates start increasing, So whether a loan in the next 3 years is going to default if we have such a U shape. And this allows us to control for a lot of stuff. And more importantly for us, it allows us to look at some heterogeneity. And this heterogeneity is related to bank and firm characteristics. So the general findings, look at the third row here, are very similar. So we find that the likelihood of a loan defaulting is increasing. This is it's increasing in the interaction of a cut in rates and the change or previous cut in rate and the change in rates after origination, while consistent with the previous literature, a cut in rates or loose monetary policy is also associated with higher likelihood of loan default. You see, we can include a lot of controls and fixed effects here. And then the more interesting part is that this also allows us to additionally interact this, do the triple interaction. So of, first of all, the double interaction that we were looking at, and additional variables such as whether the firm is a real estate firm, the borrower, whether the borrower has been audited, which is basically a signal in the Spanish data for being a bit more risky, being more risky if you're not audited. And in some of the data, we have the cost of credit of this firm. So it allows us to assess whether this firm already paid a higher cost of capital due to, or potentially due to its riskiness. And it also allows us to include the bank non-performing loan ratio as a measure of riskiness of the bank that is lending to the firm. And you see that these interactions, most of them come in significant, and at the same time we see that the borrower risk characteristics seem to matter, and the bank risk characteristics seem to matter. So it seems like in this period of low interest rates, a riskier borrower is more likely to receive credit, or a bank that, based on the NPL ratio, the non-performing loan ratio, is riskier, seems to supply more credit. And then the final specification is to look at the link between the two, and we see that it seems more likely that in these that a loan granted in this period from a bank that has a high NPL ratio, lending to one measure of risky firm, real estate firms in this case, it seems more likely that this loan is going to default. Yeah, so I think I'm out of time. Do I have time for the quick conclusion? So we find that banking crises are preceded by a U-shape in monetary policy. It seems particularly dangerous to raise rates once you, or if interest rates were decreased or cut over a long period before, especially if you are in a boom scenario where measures of credit growth and measures of asset prices are already elevated. And then in the microdata, it seems like this could be driven by particularly risky firms receiving credit during these episodes, or particularly risky banks extending credit during these episodes. And the bigger picture implication is that and there are some papers doing that for monetary policy, looking at other variables than financial crisis. But it seems like the financial stability trade-off when you do monetary policy seems to depend on previous interest rates. And then if you end up in a boom situation, or you should try to avoid ending up in the red zone before the red zone actually materializes, because once you are in the red zone and you have the need to reduce to deflate this boom, it's very risky to increase monetary policy rates. Maybe, but obviously we have no evidence on this, macroprudential policy might be the more appropriate choice in that. Thanks a lot.
Okay, so let me start by just doing the standard disclaimer as an employee of the central bank. And after that's done, I'll get straight into my take in the paper. I really like this paper. It's very nice. So thanks, Björn, for giving the opportunity to read it. What I think this paper does very nicely is tie together these ambiguous findings in the literature about the role of interest rate cuts or hikes for causing financial risk. So in the paper, they go through very carefully the different evidence that exists for either side of this. And what they do is to introduce this path dependency and say that this will reconcile the evidence that exists in this literature. This is, I think this is a very opportune time for you to have written this paper. Across many jurisdictions, we've now seen the last year to 2 years, big increase in nominal interest rates. And it's coming after a period of time where interest rates were very low. So I can see why this would be the motivation for writing the paper. The effects are economically large. You showed this is compared to this conditional crisis risk or the other kinds of paths of nominal interest rate you could look at. The effects of having this U-shaped policy path are large. So the takeaway is that it's not per se an increase in interest rates that causes this materialization of financial risk, but rather this being the up leg of the U, and you need to consider the down leg. Incidentally, thinking of financial crisis, you're using the 17-country version of the George Shooter Taylor dataset. People might know in the more recent version, there's an 18th country being added, which is my country. So I promise you, if you use that version, you will increase your number of financial crises by at least one. So what the paper did for me was to provoke me to have to think about how monetary policy and financial stability should interact. So I'm going to spend a good bit of time talking about the policy implications, but first I'm just going to talk about the representation of monetary policy in the paper. So the paper is exploiting this path dependency in the path of nominal interest rates. There is another way to think about this, obviously, which is stance. So everyone's familiar with concept of R-star. It goes back to Vixel. A number of different papers over the years have stated or restated exactly what this quantity is. In some of the work by Williams, it's summed up as being the interest rate that holds when the economy is potential output and all sort of aggregate supply and demand shocks played out. And in the paper by Colson, Lowak, and Williams, they say that you could think of monetary policy as being expansionary if the short-term real interest rate is going to lie below this natural interest rate. And this leads into the recent paper by Grimm, Jordan, Schuler, and Taylor, in which they use this 18-country version of the data set, and they have estimates of the natural rate for these 18 countries in this extension to the paper by Del Negro, Giannoni, and Tambaloski. So they define stance as being this 5-year average deviation of the real interest rate, short-term real interest rate from the natural rate. Let's skip to this is taken from their paper. What the mechanism is, the stance is loose in the years before the red line, which is the financial crisis, and it causes increase in risk through this increase in the credit to GDP ratio. So I think one nice thing to think about would be how to synthesize the approach of your paper and that paper. Because that paper is not itself thinking about the shape, and you are. So on to policy implications. The paper is quite forcefully the argument that monetary policy dynamics have important implications for financial stability. And then the question that kept occurring to me is, armed with this takeaway, what should the monetary policy maker do differently? There's a suggestion to avoid getting into the red zone and to avoiding having rates being too low for too long. But then there's this larger question of how to reconcile this with monetary policy being set endogenously in response to the inputs in your assessments and based on your mandate. So if you thought of inflation was persistently below the target and you did this assessment and you came up with a decision that it was warranted to loosen monetary policy, that was what in an inflation target central bank, that's what will be consistent mandate, but it's obviously going to, through the evidence in your paper, going to cause an increase in financial risk at some point. So is one of the takeaways from this paper that monetary policy mandates need to be thought of in a more wide sense? Are they missing out on financial stability effects? One thing that came to me then was obviously the Tinbergen rule, you know, number of targets, number of levers. How should we think about, is it too much to expect of monetary policy to bear this responsibility for financial stability, and should it be somebody else, some other actor's role to think about this? And then another sort of thought that occurred to me on a practical sense from meeting to meeting, you were the staff briefing senior monetary policy maker. Should you be thinking more about path dependence? I'm not sure it sort of comes in that much. And then, or just as a general takeaway, should monetary policy makers push back and focus on their own mandates as defined and leave it to prudential regulation or a macroprudential policy setting group to address these FS issues? One nice exercise that's in the paper is this kitchen sink Taylor rule approach, in which you bring in credit dynamics, house price growth, equity returns, to talk about what a prescription for a Taylor rule would look like if you brought in financial variables. I wonder, could this be like more commonly used? Should we think of bringing in these variables more, or is it also a case of state dependence that if you were in a red zone, I think this is argues if you're in a red zone, you should behave differently, and ultimately this is reflexive to just don't get into a red zone is basically one of the issues. And then you could think, I think we could talk more about the trade-offs, regardless of this inflation example. You know that loosening monetary policy can cause an increase in economic activity in the short run, but it's going to come at the cost of this future financial risk. So how should these formally be weighed off against each other? Then you mentioned macroprudential policy conclusion, but I think there could be more said about the role of macroprudential policy if we argue that it's not monetary policy's job to mitigate these financial stability risks. What more should macroprudential policy do? And also, if you think about the tools available to a macroprudential policy maker, should they also bear in mind this the evidence on the shape? A couple of final comments. You typically use this dummy for the loosening over the 5-year period. I wonder if does the magnitude, if this is just defined as 1, if the cumulative change is negative over 5 years, does the variation there and matter? I'd like one exercise in the paper was this length of time for which interest rates are below their average, is really getting to the prolonged bit of low for long. A bit more on this. And then the final comment is about whether the monetary policy tightening is a surprise. So I know in the historical data, this isn't really possible. Like, futures contracts really only go back to the 70s, but maybe you have your Spanish administrative data. And the reason this was on my mind is to some extent, Silicon Valley Bank is looming in the background. Is the monetary policy tightening, whether in terms of when it starts, the magnitude, or the path, is it unexpected by financial agents, which causes the materialization of financial risk on their balance sheets. Okay. I'm just going to, while I have the opportunity, I'm just going to say on behalf of Central Bank of Ireland, just thank all of the speakers today, and yeah, thanks.
Yes, thanks a lot for all these comments. Very interesting, and we will keep them in mind for the next revision of the paper. I think the first one is this paper by our previous co-authors who write on the monetary policy stance. Obviously, there's a close relation in the sense that our cut dummy is probably picking up periods of loose monetary policy. And then what we add to it is this interaction with what you're doing what you're doing after this period of loose monetary policy. Yeah, the papers came out at the same time. We didn't know each other that we were writing them. There's obviously something we can learn from that paper in terms of how we maybe how we define the cut dummy, maybe. I think, yeah, you mentioned it. We have these kitchen sink approaches somewhere in the appendix, because we thought it's like more natural to start very simple on that first part of the leg of the U. But I agree we could do more, and we are looking into it. The second point you mentioned is the financial stability mandate. I think it's not anything I can say much about. I mean, if you were at the New York Fed on Wednesday, I think there were these questions about the financial stability mandate. I think it's hard to, as you mentioned, the tin-bearing rule. It's hard to have all these different mandates that normally go hand in hand, but sometimes might deviate. That's certainly not something we can say much about. What we can say is, if you think that, or if you care about the financial stability mandate, then you should probably take this, or may want to look at the path of policy rates, especially taking into account the past changes in policy. And this is also kind of what the more general prescription would, or like outcome of the paper would be, that bear in mind that decisions today might limit future policy space. If you think about financial stability, but I was mentioning there's other papers arguing exactly the same about the prepayment channel of monetary policy, that policy decisions today might affect future policy space. And in that case here, low rates today or decreasing rates today might limit the ability to raise rates without potentially risking financial turmoil in the future. So yeah, let me take
So on the historical part of the paper, what is the quote unquote optimal T star such that after T star expansions are too long and below T star? So you showed us results mostly for T-8 and then T+3 specification, but you have obviously played around with different definitions of the U shape, and potentially by setting different case of T-K, where case in 1 to 9, you probably found an optimal case that defined that you're expanding for long but not too long. And that's what
we didn't play around that much, to be honest. I mean, we started with this these simple graphs I was showing you in the beginning, and then we did some robustness for 8 years, for 6 years, and we have another specification that you just mentioned that goes a bit in that direction, which is basically not asking for whether you have a U over a specific time period of 6, 8 years, whatever. But we basically interact or define policy as being low if you are below the 10-year moving average. So policy rates today are below the 10-year moving average. And then we define low for long periods as episodes where you are in this environment for a longer time. And we again interact this variable, how long you have been in a low environment with the changes in policy rates today. And we find a similar pattern that if you have been, in such a low interest environment for a long time, and you start increasing rates, it's riskier, or the likelihood of a banking crisis is higher relative to a situation where you start raising rates, but you have been in this environment only for a very short period of time. But we have nothing to say about the optimal length of this episode, or how long you should allow policy rates to be low.
Yeah, thanks. So I think this is super interesting and it's very relevant. I mean, it's very interesting. I think an extension of this earlier work on by Lars Hansen and others on the costs and the risks of expansion of monetary policy and the costs and benefits of leaning against the wind, if you want to say. I was thinking, connecting to David's comment about the trade-off then that, for instance, Lars Hansen and others have written about. The key thing there is, of course, how large are these effects? How much do you gain or how much do you lose there? And how much do these risks increase? It seems to me that perhaps compared to that literature, that the risks of a banking crisis seem to be affected quite a lot.
Yeah,
but then for the Spanish data, there seem to be tiny effects on the risk of bank defaults. But maybe loan defaults, but maybe I mean misinterpreting numbers. So it would be honestly.
Yeah, actually, well, it depends on the specification, but the effects on loan default are large. It's here they were in percentage points. I was rushing through it, sorry. They were in percentage points, but obviously the likelihood of a given loan defaulting is also very low. So yeah, so I think, I mean, depending on the specification, but I think our baseline, I would have to look it up. It's something like a 40% increase in loan defaults, something like that.
That seems sizable.
It is sizable, yeah, definitely.
Two questions. So the first one is whether the micro-funded rather than market-funded. I would like to see a little bit more the last part that you've shown, right? I mean, it's a little bit, I think it's easy to understand that the loans are riskier at high interest rate, they're more likely to default in that time period. But I think what you want to show is that during the periods of low interest, that the actual risk will also be made. That the risk will also be made, right? So that some banks have an incentive to make actually riskier loans. This is actually also the way that you pitched it at the beginning, and that these loans that are eventually defaulted when the interest rates will increase.
But this is kind of what we find that
what you show is basically that the loans that have higher interest rates are the ones that are more likely to default. Right? This means that the loans that were more riskier. You did. I think it might be interesting to see whether you can show something about the loans that actually originated in the period of low interest rates.
That's exactly what we do. So we look at the origination of the loan, and well, I mean, we look at all loans, but then we have this dummy variable for a loan being originated when rates were low, and we interact this with the risky in some later specifications.
The second one is actually more. I think this might be a little bit outside of the paper. Is I think it's a perfect description of the past, right? If you know, I think the Discussant alluded to sort of the Silicon Valley debacle, which of course, on the one hand, sort of like a rapid increase in interest rates after a long period of low, but at the same time, it came with a substantial expansion of balance sheets and liquidity expansion of central banks, right? So the question of what's more relevant going forward, it's actually really central banks steering sort of like the U-shape on the interest rate, and that's what's going to matter, or it's sort of the additional liquidity and what banks actually do with the liquidity that the central banks actually provide.
Certainly a good point. Yeah, we will be happy to look into it once we have more data. I think in general, I mean, all crises, it's always the problem when you work with this data, all crisis episodes are different. Whenever it's also a risk showing these crises here, because everybody has opinions, strong opinions about fund crises. In general, what we try to do here is like, yeah, find a pattern that seems to be very salient across different crisis episodes. And even though you might want to argue that some specifics are kind of different this time, even if you look at Silicon Valley Bank, credit was growing a lot. The price of this bank, if you would take a bank level perspective of this red zone, asset prices were increasing a lot, and then you started increasing rates. So I wouldn't say it's a completely different mechanism, but I totally agree that going forward, there might be interesting additional features to consider.
Yeah. So first question is a clarification. So in your panel regression across countries with the crisis, do you condition when you do those results of like having a crisis or having a recession or both, and then see whether you had a U-shape before, or you also consider an episode where you had a U-shape but then no crisis, if any exists?
Well, we do kind of in the first part where I showed you this table, we basically look at these episodes and ask what is the crisis likelihood in this one, and then in the regression we do exactly kind of the opposite. We regress the probability of having a crisis or a likelihood of crisis on measures of the path of interest rate. So they are all included. So all data is included there. Also U-shapes that didn't end up in a crisis or lambda shapes.
Thank you. About the policy implications. So I see the leaning against the wind angle. So this is clear, comes out clearly from the paper. I was wondering about then the implication for the later period when you start tightening, okay? Because of course, this is also not exogenous, it's endogenous, no? And you show that this comes with an increased risk of financial crisis or financial instability. But of course, if you think also about the current experience, this is also addressed to maintaining inflation expectation well anchored, which is also has a very relevant financial stability, say, and also.
Yeah, I totally agree. I guess we see this paper as a starting point to try to do more on. I mean, you saw that our specific. I mean, we do some robustness on this U shape, but I think there's a lot more to be done. Whether it makes a difference, how quickly you start increasing. I mean, even this 3-year period we are looking at, you could have raising rates in the first year and then flat rates in the following 2 years, or exactly the opposite. We didn't look into this at the moment, but I think there's a lot more you could do in that respect. Looking at the shape in more detail.
Thank you. Very interesting paper. So for me, I thought one of your conclusions, I don't know if I got it right, which is when you hands on ideally you don't want to continue to tighten, right? Which again, from a sort of a practical point of view, I think if you are facing some, let's say, inflation pressures, and you sort of advocating for financial dominance, but well, because we don't want to actually finance the whole sector, therefore we might have to tolerate a bit more inflation than we would have otherwise. So I just wanted to get a sense. I know that the discussion will take on that. We just wanted to sort of push on that a bit.
Well, I think, yeah, what we are finding, I mean, we have to be very careful, I guess, with policy conclusions because we have very little to say about that. What we are finding is that historically, if you started raising rates in these environments, you were more likely to end up in a financial crisis than otherwise. That doesn't mean, I mean, it's hard for me to say whether this means that you shouldn't, I mean, at some point you have to start raising rates. So I think, yeah, this is a starting point to look at these questions, but yeah, I think there can be done a lot more to answer these.
Okay, thanks very much, everybody. We'll call it there.
Thanks again. Nice comments.
Yes. My glass of, I was thinking of the last one. Because they require us to work. I think I know how right, because I'm really well, what I'm sure was more like yeah, I was thinking I saw your
Yeah, thank you so much. If you ever want
Usually with my great.
Though we saw your paper and like this is exactly our mechanism, and then somebody was like, wait, it's about real rates, and we're like, oh yeah, we have to look at it again.
Yeah, I'll send it to you.
Yeah.
I've been corresponding before with
Dmitry, and yeah, exactly. You said you guys.
So I'll send it, and maybe we can chat about it. I mean, I still see it very much in the sense that the both the short run and the long run are.
No, I agree with you. Probably, I mean, we didn't find anything in that respect, or not so clear. Let me. So we do the same for real rates, and the pattern look much less clear than they did for real. But I think it could be just because our real rates are not as good because we cannot measure anything. So we compare them based on it could be that everything is about real.